Joining me now, Anastasia Amoroso of iCapital, Mira Pandit of JP Morgan Asset Management, and Mike Rohde of American Century Investments. Good to have everybody here. Anastasia, you first. Your thoughts?
Well, I think finally, Scott, this is starting to feel like a washout. This is starting to feel like a capitulation in the market. We've been waiting for the market to, on a broad basis, to hit oversold levels, and I think we're going to get there today. If not today, most likely this week. And if you look at the Mag 7 stocks that are hit really hard today, they have already been oversold. So what we've seen, Scott, is really a buyer strike. We've seen a lot of sellers come into the market from the systematic investors. Hedge fund community has been selling. Retail traders have essentially boycotted this market. So that's why we've seen this unwind. But fundamentally, Scott, I will say recession fear-mongering, I think, is what's being listed as a catalyst for this. But why do we have a recession all of a sudden? What indicators actually point to a recession? We have a relatively strong payrolls report. We have consumer spending that is still pacing 3 or 4%. So I don't actually see the reasons to fear a recession at this very moment. So what we need, Scott, is a circuit breaker, some sort of a catalyst to put an end to this. And I think we're going to get it this week or next.
Detox is painful. I mean, the Treasury Secretary came on this network and used the word detox. That's what we're going through. The only question is whether it was a juice cleanse or you needed to go away for a little bit. This is painful.
It is painful, but I would agree with Anastasia in that we haven't really seen tangible evidence that the economy is slowing. And we are starting with such a strong buffer. 9 of the last 10 quarters, we've had above trend growth. We look at profits, expectations for 12% profit growth. If we get half of that, that would be in line with a typical year of pretty strong profit growth. So there is quite a bit of a buffer in the markets and the economy to absorb some of this. I think what has changed is the only thing to fear is fear itself. And there's a lot of that, especially around what are the pain thresholds. So there was an idea that the Trump put would support the market at some point. There was also, for many years, a reliance on the Fed put. But now if we're in an environment in which the administration says we're willing to take a little bit of pain and disruption, and the Fed says we still need to keep the eye on inflation above all, then that complicates matters in terms of who's going to swoop in and save the market. And if you layer on top of that the tech sell-off that we've had for so many instances in the last couple of years, tech has actually been pretty defensive, and that's not the case anymore. But we are seeing a genuine rotation into some of the other areas of the market that have previously been unloved. And I do think that is somewhat encouraging amidst all of this.
Secretary Bessent also said no Trump put. And it's debatable as to what degree there's a Fed put.
Yeah.
If you have a slippage in the economy, but inflation remains above target with the unknown of tariffs on top of all of that, with an early April reciprocal date once the report's in, maybe their hands are tied for a bit. What do you do?
Yeah, it's tough. What is interesting to support the call that, hey, there's not a recession around the corner, if you look at high yield spreads, they're still near all-time tights, right? So not indicating that there's something brewing right around the corner.
Widened a little bit.
Widened a little bit.
Not
Still
as
three.
Sort of calm as where they were.
For sure, as you would expect. But on a down 1,000-point day, there's not a lot of panic in that market yet. But you do have to remember, we entered this year with the S&P 500 trading at 22 times earnings. That's versus 16 on average. So stocks, especially high growth, momentum tech stocks, were priced for perfection. And now you have potentially slowing growth for, slowing spend on phase 1 of AI. That mixed with high valuation is a pretty tough environment. And so there has been a rotation. It's a really good thing to be boring right now. Value stocks, mid caps, financials.
Financials?
Yep.
Ugly.
Yeah, it has been ugly, but we see very high quality. Capital levels are still really strong at a lot of these regional banks. Deregulation should help, and there's no impact from tariffs, not directly. So there are pockets of this market that actually, with the sell-off, creates some really good opportunities for active management.